Hello everyone, welcome. My name is Agostino Pintas. I'm with Bulletproof Cash Flow. Today we're going to talk a little bit about a net lease fund, how it works, how it's set up, right? It's going to be very high level. We're not going to go into any of the details or anything else like that, okay? This is really just a introduction, all right? It's going to be an introduction on how net lease funds work and some of the things that maybe you as an investor want to look for when you are considering investing in one of these as a limited partner, okay? So I'll give you a little bit of information about myself. My name is, as I said, Agostino. And what we do is my team and I, we do three primary things. Okay, the first is we invest in multifamily assets. Okay, we acquire B and C type of assets. Secondly, we do adaptive reuse development. Okay, so typically it's adaptive reuse of historical assets, but we also do ground up development too. But our specialty is doing urban infill, meaning we're looking to develop assets in areas where there's already a lot of traffic and there's a lot of money already transferring through, okay? So it's good when you're developing in those types of areas. The third thing is specifically we're gonna be talking about today, the net lease business, okay? We actually have a blind pool fund, and I'll get into that, what a blind pool fund is, but in our blind pool fund, what we do is we define for our investors what type of assets we're gonna be buying, and then we collect all the cash from all of us, right, ourselves included. We also invest in these types of deals. And then we go and acquire these assets. And then we do distributions on a monthly basis. So it makes for a very interesting way to get steady monthly cash flow and no matter what's going on in the economy. That's the reason why we attacked that line of business, okay? So, but like I said, we're going to get into a little bit of details. There's only certain things I can and cannot say, but to that end, just, you know, I'm going to probably say this a few times, but you know, this is not a solicitation of any type of investors' money or anything else like that. This is not what we're doing here. This is all education only, right? So just I'm going to reiterate this a couple times because I want to make sure that that you guys are aware that all we're doing is just helping educate folks on how this stuff works and what it is, because listen, when I was on the come up, I was working in corporate. I had no idea about all these various tools that is at our disposal today as investors, right? So I was going the typical route, just like most of you guys are, doing the whole 401k thing, investing in stocks and mutual funds and things like that. I had no idea these other tools existed. And I'll tell you, it's interesting when you realize you can invest in a net lease fund, for instance, get monthly steady returns no matter what happens in the economy, no matter if they shut down the country for whatever reason, you'll still get your return, right? Because there's a corporate guarantee backing up those individual assets, those individual stores that we're buying, right? So it's a very attractive investment vehicle for those people that really want to have some solid footing as we go through this economy, as we go through this this recession, and continue on down the road with that. Because here's the thing: I mean, if you're able to build enough revenue coming in on the net lease fund, for instance, you're able to secure yourself, secure your family, and protect you against the storm that is the economy, right? So you want to make sure that you do that, and net lease funds is a perfect vehicle to do just that. Okay, so let's get into it. So on a net lease fund, typically there's accredited, non-accredited investors depending on the fund itself. Okay, very similar to when you're doing a syndication, right? A syndication, some of you folks out there might be familiar with. It's when you're investing in a single asset, like say a multifamily deal, right? The syndication. A fund is very, very similar. The difference in what I mentioned earlier was a blind pool fund is that we're telling you up front, or whoever it is, that the fund manager will tell you up front, these are the types of assets we're investing in. We're buying these types of single tenant net lease assets, for instance, Dollar General, Dollar Tree, VCA, Advanced Auto Parts, whatever, with corporate guarantees. And we're going to buy these types of assets with these types of return targets. So it's all told up front, so you as investors know what to expect when you're investing your cash in these types of deals. But generally speaking, there have to be, there's certain, you have to be accredited or not accredited or whatever, depending on how the fund is set up. Now, in the same case with syndication as it is with a fund, you're pooling your money together into a fund. Okay, so everybody is pooling their cash into the deal, and then we go and acquire these assets. Okay, that's generally how it works. So it's very interesting because it's very similar to syndication, right? With a fund, we're pulling the cash assets, or a fund manager will pool the cash and they just go and acquire it. And it's a bigger deal on net lease. And again, we'll get into that here in a second, because today we're going to cover a few things here. We're going to cover what is a net lease fund and how does it work, the benefits of investing in a fund versus doing it on your own. We're going to cover setting up an investment strategy and the overall philosophy of a fund. Very, very important. Okay, fund managers always define this up front so you're aware of it. How a fund manager may evaluate and manage risk. And then we're going to go through the three key technical advantages of a fund. Okay, so let's go ahead and let's get started. So first, what is a net lease fund? So like I said earlier, a net lease fund is an investment vehicle that pools capital from multiple investors. Okay, pools capital from multiple investors to acquire a portfolio of net lease properties. Okay, so the properties are then professionally managed by an experienced team. So in a net lease arrangement, the tenant is responsible for the majority of the expenses, the maintenance, the repairs, the taxes, insurance. So when you're able to, as a group of us, go and acquire a Dollar General, for instance, a single tenant location, right? Single tenant location, and the tenant's responsible for all the expenses, or majority of the expenses related to that location, and they pay the lease, they pay the rent to us as owners. It means very predictable passive income for us as investors. Okay, that's generally how it works. Except what we're doing is we're not just buying just one asset. We're buying a whole bunch of these assets, right? It could be 10, 15, 20 of these various locations. So just like other folks out there that are doing the same sort of thing, the fund is going off and buying these assets either one at a time. You know, maybe they're opportunistic, or they're buying an entire portfolio of these things, right? Just depends. So many of these guys, they focus on a variety of different types of assets. Some do single tenant net lease, some do entire strip centers, some do malls, some may even do industrial, maybe they do self-storage. You know, so there's a variety of different things. Okay. But generally, the type of things that we like to do is we're looking for strong national tenants with strong credit ratings. That's what we're looking for, because we want to make sure that they're going to be around for the long term. We want to make sure there's solid leases in place. There's rent increases built in, and the tenants, they have corporate guarantees on those leases. Okay, those are the best types of tenants to have in an asset that you're going to be buying, generally speaking. Okay, so if you have that type of asset, a Dollar General, brand you know, love, and trust, with all of the things I just mentioned, you got a nice solid lease in there. You got rent increases. You have them responsible for many of the aspects related to the property, and they're paying rent every month. It means for investors, nice, steady return. Are you going to become a billionaire doing it? Probably not. Maybe if you go public one day, right? Maybe if the fund goes public, there's a way to do that. That's a whole other discussion, right? But generally speaking, if you get, like I said, one of these locations, but you get like 10 of them going, all doing the same sort of thing, nice, steady return, right? To that end, the fund allows you to invest in these stable assets while getting that portfolio diversification, and you also get good professional management that's in place. And what I mean is that, like in our case, we've done a lot of assets outside of net lease too, right? We've done a lot of commercial deals. We've done $350 million worth of stuff already, just in development and acquisition. So it makes sense that we know how to run these types of properties. We know how to put them together. We know how to put the deals together. You got to know how to negotiate the debt and all that sort of thing, right? Those are the types of things that you really have to know how to put together when you are when you're putting these these types of things together, right? So professional management is very, very important. And any types of funds that are out there, you want to make sure that the leadership team is very familiar with how to put these deals together and and how to pick the right assets. All right, that's probably one of the key things. The underwriting is extremely important, extremely important. So now, why invest in a fund? Well, there's many advantages to investing in a net lease fund versus trying to do it on your own. Okay, so first of all, you get that diversity, right? So like I said earlier, sure, you can go out and buy $1 General, all right? $1 General for, say, $800,000. You can certainly do that, okay? Now, all your cash is invested in one deal. Great. So now you're going to get the type of return and everything is going to be super. Well, keep in mind, when you're investing in a fund, as a limited partner, you're not just getting that one location. If the fund is run properly, you're investing in like 10 of these types of stores across multiple places and across different places too, right? So what does that mean? That you're going to probably get the same sort of return. The difference is that you're not having to mess with it, right? All you're doing is getting a check. And because it's so predictable, it just shows up in your bank account right down to the day in most cases. So it's something like, why take on the overhead of dealing with it if you can just invest the same amount of money in a deal that limits your risk across multiple properties and reduce the overall risk. So let's say, for instance, one property does underperform in the fund. It's okay. It balances out with the rest of the portfolio, as opposed to being in one property and that one property has problems. Now you're hosed, right? You don't want to do that. It's probably not a good idea. Management. Now, typically you want to be invested in a team that knows what they're doing, right? The team will handle all the aspects of sourcing, underwriting, closing, property management, and investor reporting. So this will help you, of course, keep track of what's going on with the portfolio, right? Which is obviously important. Number 3, access. Okay, by pooling your capital together, the fund at large allows both accredited and non-accredited investors, depending on the setup, to participate in larger deals that would normally be unobtainable by doing it yourself. Like I mentioned earlier, maybe you can do a deal for $800,000. Maybe it's it's Dollar General in the tertiary market, far, far away. Okay, maybe you can buy it on your own. Great, super. So now all your capital is tied up in one deal, $800K, as opposed to investing in a fund with the same amount of money. Let's say you're going to put in $200,000 or $300,000 into that deal, but now that $300K is spread out across multiple assets, and typically those assets, because we have more buying power as a group, you're able to take down larger deals. Larger deals have lesser risk and typically also have a better return too, right? Because generally speaking, in a net lease world, a lot of folks are buying those deals that are less than $1 million. We're trying to target deals that are greater than $1 million, and there are fewer people playing in that space, right? And that doesn't go for us too. It goes for a lot of other folks as well. Like they're typically trying to buy bigger and bigger deals. Those bigger and bigger deals have greater returns, generally speaking, right? It still comes down to buying the asset right and making sure you're getting into the right deal. All right, those rules always still apply. Okay, what else you get? Passive income. These net lease properties provide stable, predictable income. Most of the expenses are covered by the tenant. And having a fund that makes owning these assets turnkey is tremendous, right? One less thing for you to worry about, right? Because again, the predictability is really what you're paying for, right? Knowing that that money is going to show up no matter what happens, okay? So I think that it's worth mentioning whenever you're investing in one of these types of deals in any type of fund, okay? First and foremost, the fund must have a clear investment strategy. Clear investment strategy. This goes beyond like whipping out your checkbook and start writing out checks. All right. This is you have to understand that if the philosophy of the fund does not match up with what you want to do personally, then maybe you don't want to do it. Simple as that, right? The fund has to really have a good philosophy and a good mission. What is the mission of the fund, right? Some funds, maybe they're looking to acquire certain types of assets. Some funds, maybe, you know what, maybe it's one of those things that a portion of the revenue goes into some sort of charity or something like that. And maybe that resonates with you too. That's cool too, right? There's many, many, many different funds out there that do various things, okay? Like some funds, they are centered around necessity-based value-add net lease real estate, okay? Those are the types of things that we like to do. And but there's plenty of other folks out there that do a whole lot of different things as well, right? But like I said, like I personally like to focus on properties where people like to live, work, eat, and shop on a daily basis. That's the type of thing I like. It's very, very similar to our development business, where I'm doing urban infill, and I specifically do urban infill because there's already people there. If there's people there, it makes my job a whole lot easier on the lease up, right? Net lease is very similar. If there's already people there, there's a built-in market, and you're acquiring an asset there, you're not like worried about if there's going to be enough traffic to support that business, right? It's going to be there anyway. So generally speaking, most funds out there usually target tenanted, established businesses that provide essential goods and services. Again, like I mentioned before, you get the Dollar General, the Dollar Tree, dollar stores, right? Auto parts stores, especially during times of recessionary pullback. Auto parts stores do very, very well. So even in boom times, they do well, but in economic slowdowns, they do very well. That's because many of those C and B type areas, they hold on to their cars longer and go to the auto parts stores to buy the parts and buy everything else that they need to keep the car running for extra time, right? Veterinary clinics is another one. You know, it's interesting that during COVID, there were many people still cared for their pets, right? I mean, of course, they're a member of the family, right? They were open during COVID, you know, so it's one of those things that many people just don't really think about. But yeah, veterinary clinics, and then of course urgent care clinics as well, right? So but regardless, the types of funds that invest in brands that you know, love, and trust in your everyday life, those are the ones that will survive the longer term, right? And no matter what happens, with that lease in place, you know that they're going to perform every single time, okay? So part of what the better funds do anyway is they do a very rigorous, data-driven approach to identify and underwrite the most stable, profitable net lease opportunities. This is one of the most time-consuming parts of doing these types of deals. You really have to understand how to do that kind of thing, right? And now my background is IT, and my wife's background is tech as well, right? So we have a really good understanding of how to analyze the data and how to put the type of models together so we understand the opportunity, understand the demographics, the traffic, all these types of things. Very, very important to selecting the right deal, right? But the priority, no matter what, should be among all fund managers is always capital preservation and risk mitigation. That is ultimately what the fund is supposed to do, at least in this case anyway, okay? Number 4, how do we evaluate these and manage risk? So evaluating and managing risk, just like I said a second ago here, is one of those imperative aspects of a fund. Okay, if a fund is set up properly and the mission is set up properly, the investors that are investing in the deal should have a level of comfort knowing that it's going to either be, you know, what risk level it's going to be, right? So generally speaking, when you're doing a net lease fund investment, okay, the whole purpose of a net lease fund is to mitigate risk and protect your wealth, ultimately is what it is, right? It isn't like the fund is set up to go after distressed assets or go after office buildings or go after some of these things that are now trending in the market these days as a potential huge upside down the road at some point. That's all cool, I'm not mad at it. However, in the case of net lease, we're looking to mitigate risk. Okay, so what does that look like? So generally speaking, a fund, a properly set up fund, is going to look for sufficient traffic. They're going to look for population density. They're going to look for the online reviews on Google and Yelp. And they're going to look for those types of things. And they want to look for opportunity to see, is there a chance for this location of getting shut down for any one of those reasons I just mentioned, or others as well. Those are just some of the key points. Many of the fund managers look at a variety of different things. Okay. Now, we also look at the tenants and their established credit grade as well. Okay, so many of the other guys do the same thing. They're looking for their credit, whether they have long-term leases, whether they have built-in rent increases. Sometimes those rent increases aren't there. Sometimes they're not there. Sometimes they are just they're flat. In some cases, we see a lot of, say, Walgreens, for instance. Walgreens has, in some locations, the rent is flat for 10 years straight. So clearly, that doesn't really fit our model. We don't go after stuff like that. Other people might, and that's okay. So ultimately, anything that a properly set up fund will do is provide recession resilience. That's ultimately what we're looking for, right? So we also utilize creative financing strategies. So these days, whenever there is a pullback, like I said before, and interest rates start climbing, markets are slowing down, deals still take place. Maybe you just don't hear about them. And there's many, many, many ways of putting a deal together. It doesn't always have to be going to the bank to get debt. Sometimes you can grab debt from the seller, right? Sometimes the seller is willing to carry the debt for some length of time until things finally settle down a little bit. And you have to know how to put those sort of deals together. Now, we have experience doing those sorts of things at a variety of different types of businesses. As a matter of fact, I bought a 200-unit apartment building doing just that, right? So you have to know how to put those types of deals together and have experience doing it too. So another key aspect of a fund is having diversification across multiple properties, multiple tenants, and multiple geographies. Because ultimately, a good fund is going to avoid concentration risk. The last thing you want to do is have 15 stores in one zip code and something happens in that zip code. Maybe there's a tornado, maybe there's a huge snowstorm, it shutters the whole place and just wipes out the whole area. I don't know. The point is that by having diversification of geography, for instance, different assets, for instance, you're reducing the overall risk in case something happens to one of those locations, right? So, insurance. The cool thing about these types of assets, just like multifamily and anything else for that matter, is insurance. Typically you have, if there is a problem and say some tree falls on top of a Dollar General and destroys it, well, they still have to pay the lease, and all the insurance is still in place to rebuild it, right? So very similar to the multifamily space, right? So as an investor in these types of deals, the risk is very, very limited, right? It's a very limited risk type scenario. Again, the fund is still there, and when you have multiple assets in one fund, you're mitigating it further. Generally speaking, a good fund is going to have reserves, they're going to have corporate guarantees as well on those leases too, right? So I'd say though that the biggest part of all this is the due diligence process, okay? At the very, very, very beginning. When a deal is first put together, it's really the due diligence. The first 30 days is the time when the buyer has the most leverage of getting a deal done. After those 30 days have passed, the leverage decreases. So how do you use that leverage? You use that leverage to look at the asset, look at any deferred maintenance, look at any of the bills, look at any of the leases, try to find any surprises, get to know the tenant, get to know what their intention is, right? By talking to the manager, talking to the people there, all these things are absolutely critical when you are underwriting a deal. So as you can imagine, it takes a great deal of time to do this. And if you're trying to do it yourself, and if you've never done it before, it's a challenge, and I'm not going to pretend it's easy to do this stuff, but, once you get really good at it, though, you kind of know what you're looking for, right? So there's generally 3 technical advantages that enable some funds to really deliver superior results. And these are things that we take very seriously too. So the better funds take a data-driven approach, right? So I mentioned earlier about the IT experience that we have in our group, and having a consumer-centric approach that we look at spending patterns, traffic analytics, population density, other key metrics. Again, it leads to a very different level of sophistication when you're putting these types of deals together, right? So not everyone knows how to even gather or even apply the data to know if it's a good deal or not, right? Secondly, institutional understanding of the consumer behavior, right? And what I mean by that is a lot of the team members that, at least in our management team anyway, have worked in corporate. So there's a certain level of institutional understanding around applying some corporate behavior around how data is managed and how the business is managed at large. And we have that type of thing. And many of the sophisticated fund managers out there do the same sort of thing, right? So we know what drives performance, not only as a business, but also as an asset. Very, very key, okay? And then third, we provide an easy way to access your data, right? So there has to be a tool available to you so you can access your investment 24/7 and have a high degree of transparency, open communication, and regular reporting. If you feel that you're not going to get that, then maybe you ought to consider investing elsewhere, right? So that's very, very key, right? So, okay, in summary, like I said, net lease funds offer a way for both accredited and non-accredited investors to participate in stable, passive real estate assets, okay? So by investing in a portfolio that is diversified with professional management and multiple levels of risk mitigation, you can have a great way to earn stable monthly cash flow, right? And I'd say that if you're able to align yourself with a disciplined investment strategy, right, run by successful fund managers that know what they're doing, then it's going to lead to you really benefiting from that return for you and for your family, which is ultimately why most of these funds are put together, really. So that's it. That's all I have. If you have any questions, go ahead and drop them in the chat. We're also going to be posting this on YouTube. And if you have any questions there, just go ahead and drop it in the YouTube as well. There's other links there as well. You can also check out if you want to reach out. Go ahead. You can reach out to me, and happy to answer any other questions about how a net lease fund works. Okay. That's it, guys. I will talk to you again soon.